And Jolomeo Doharo joins us now to give us more insight. Head Research at Strategies at Cordros Securities. Hello, Jolomeo. Great to have you.
Good morning. Thank you for having me.
Good morning. So the inflation numbers came in higher this morning, as expected. But did you anticipate this level of rise at 18.17%?
Yes, we did. Our forecast was actually at 18.24%, expecting about 1.6% month on month. So this was, largely expected. So far in the year, what we've seen is, pressure when it comes to food producing states due to insecurity in that region, as well as limited gains from the reopening of the border. And so it was expected that we're going to see rising inflation, and our expectation is that we're going to see that all the way through to June, when we'll see the peak. Thereafter, we expect that the base effect will come into play in July, and the harvest season in around September should lead to a moderation in the second half of the year. However, for now, we're going to see rising inflation numbers. Looking at what we expect for the rest of the year, we expect inflation to end around 16% by December 2021 and average at 18.06% for 2021.
Now, looking at the figures, we see that all the four parameters have moved in the same direction: the core, food, headline, and even the month on month. Now, CBN has often said the cause of inflation is an output problem and not money supply. Now we have seen this trend. Would you say it's an output problem or money supply or both?
No, it's obviously not due to money supply. The issue surrounding the food basket, are well versed. Coming from last year, we had the shutdown on the borders, and you have a significant amount of security in the food producing belt in the country. So that is what exerted a significant amount of pressure on that side. And for the core inflation side, we also know what's been going on with the VAT increase and tariff hikes, as well as the PMS price adjustment that has been rolled back. So, those are the major problems, or those are the major pressure points on inflation, as opposed to a significant rise in M2.
All right. The rate of inflation has gone 100% above the inflation ceiling of 9%. Average African inflation is 8%, and we're 10% above that. What do we do to stem this tide?
The issues around inflation are structural, and it's going to take a while to cause a serious correction. Don't get me wrong, these numbers are alarming, and it's something that really, really needs to be taken quite seriously and focused on. But again, it takes concerted effort from both the monetary and fiscal authorities to arrest the significant rise we're seeing in inflation. But it's not going to be a short-term fix, not possible.
Now, do you think it's now time for the central bank to perhaps increase the interest rates? So how long can we continue to maintain a low interest rate?
We've already started to see signs that we're going to move towards a more hawkish stance. Yes, the MPC then notes that at the last MPC meeting that inflationary pressure was a concern. But now what we started to see, our expectation was always that we're going to see a hike at the end of the first half of the year in the May meeting, and we maintain that position. And signals already from how the Treasury bills markets are trading. The PMA auction yesterday is already up to a 9% discount rate on the 1-year Treasury. It points towards an overall switch from the lower for longer mantra we had at the tail end of 2020 more towards a hawkish stance. And we do expect a 50 basis points increase in the May meeting, and overall a 100 basis points increase in the monetary policy rate for 2021.
All right, let's look at this from an investor standpoint. How do you expect bond investors to react to this news, and what is your outlook for the rest of the year?
For bond investors, if I look at it from a fundamental perspective, looking at the term structure of interest rates, a rise in inflation and a rise in the base interest rate should lead to a higher risk-free rate. So bond investors are going to be demanding for that. You add to that rise in inflation and the impact on real return, you should see bond investors also requiring higher rates for that. So all in all, looking at the yield environment, it should lead to higher yields. And I mean, that is what we've seen so far this year. You add to that the government's the announcement that they were looking towards securitization of the ways and means balances, and the need to allow interest rates trend upwards so that investors would be able to buy those bonds. So I mean, looking at everything, all the dynamics in the market now, it does point towards higher yields in the fixed income market, but then it's also tethered, or there's also a second side to that. If we get to a point where you have issuances of the euro bonds, which should take care of the foreign borrowings leg to a sizable amount, and then you also have the government enacting the tenets of the Finance Act 2020 to borrow from dormant account balances as well as unclaimed dividends. I know that's being challenged at the moment. Then you have a significant amount of domestic borrowings also taken care of, in which case there would be a demand supply imbalance, such as we saw in 2020, and then yields would trend downwards. But all those factors I just mentioned are still over the horizon. For now, all the factors point towards higher yields for investors over at least the first half of the year.
All right, we have seen the inflation trajectory going higher, and of course, we're talking about the federal government talking about still borrowing, going to the Eurobond, and they're planning to borrow about $3 billion in the Eurobond market. Now, seeing the rising inflation here in Nigeria, and of course, the inflation number in the US just came out and tended higher above the 2% band. Shouldn't this be a worry?
I mean, if you, it's. I mean, if I say the worry for me would come from the significant amount of financing you're seeing, or the significant high cost borrowing you're seeing at the moment. But if we look at the Eurobond market, or I mean, if I'm getting your question correct around where the yields would drop, I mean, Ghana just issued a Eurobond that was very, very oversubscribed. And yes, the yield was significantly higher than it would have been in the prior year, given that inflation in the US is rising, like you mentioned, 2.4% at the current time. So, I mean, yes, you do have a situation where you are increasing your um, interest or cost of debt significantly, but it's also a situation where you have to plug the fiscal deficit. And right now, I think that's the more concern for them right now, given that there's still quite a bit of way to go get um, to cover the fiscal deficit when you look at income legs as well as the expenditure leg. So yes, it is worrying given that we've expanded our external debt so significantly over a short period of time, and then issues around debt sustainability will come to the fore eventually, obviously.
All right, Jolome, are there factors or events to watch out for that could bring some respite to the upward movement in yields? And how should investors align their positioning on the yield curve, given those factors?
I mean, for us, like like I just mentioned, there are some factors to watch out for. I would say the most significant of these factors would have to be that could obviously cause a reversal in the trajectory of yields is if the government can borrow significantly outside of the market. And like I did mention, on the external debt side, there was no plan to issue a Eurobond this year. In fact, the Eurobond that matured at the start of the year was allowed to mature without a rollover. And so now we're seeing the government come to say they would borrow a Eurobond. If multilateral financing comes from the World Bank, AFDB, or any of this other multilateral agencies, then external debt leg is sorted out. The second part comes from the Finance Act. The Finance Act, um, it's in there that allows the government, or the government should be able to borrow from dormant account and balances as well as unclaimed dividend to the tune of 895 billion. So far in the year, government has done about 650 billion in domestic bond markets. If you add that, if that comes to pass and you add that, then all of a sudden you have significantly lower borrowings from the domestic leg than you would expect. Add to that higher crude oil prices, then all of a sudden you wouldn't be seeing such a significant supply in the bonds market. That would cause a reversal in the trend that we've seen so far in the year, because right now the government has to significantly borrow, and so the DMO is coming to borrow at increasingly higher yields. If that changes, then we'll see a reversal in the yields. But for now, all signs point towards higher yields, and so it's advisable that investors, if they must stay in the market, either go short or stay at the short end of the curve. That way, they're not too affected by the significant movement in the yields. For those investors that don't have a trading objective, this is a good time for them, because are seeing yields of about 14% at the long end of the curve, which means that they can lock in those substantial yields over a long period of time. Now, I do believe that those investors should look at this, because at the end of the day, um, we don't see yields trending significantly upwards from this point. If the reason why the DMO has let yields trend to this level is due to the upcoming or their plans to securitize the ways and means um, balances of the CBN, then it doesn't make sense for them to do it significantly over the cost at which the government is currently carrying that debt. And that the cost to the government at this point is MPR plus 300 basis points, which is about 14.5 percent. So looking at where the long end of the curve is now and where that borrowing cost is, I don't see a lot of movement beyond that point. So investors looking to lock in at that level would be attractive. So that covers both the trading investors as well as investors looking to hold over a period of time.
All right, that takes us to, of course, what happens at the equities market. Now, considering the full year 2020 earnings season, which tempered market reactions to rising yields, and the first quarter has come to an end, do you expect continued sell-offs in the equities market, and, of course, given this trend in inflation?
So I mean, for equities market, or looking at dynamics between the fixed income and the equities market, on the base case, everyone would basically just say as yields rise, equities market performance always drops, and I mean, the reason for that is because investors will take a high risk-free yield um, over the uncertainty of the equities market, and this will continue, even though the argument is far more nuanced than just an interest rate play. I'm looking at the equities market. The truth is that yes, if you look at most of the companies in the market, you say that revenues should increase given increasing real growth, as well as the inflation giving a backdraft to that revenue growth. But then inflation also has an impact on margins, which means that earnings growth may not be as strong for a lot of companies that may not be able to pass on the cost to their customers. So looking at equities market performance in this current dynamic, I would say that it's overall more negative. Um, and so I would expect to see equities market performance continue to lag while we have interest rates at such levels as we do right at this moment.
All right, thank you very much, Jolomi, for sharing your time with us this morning. We do appreciate it. Thank you. Enjoy the rest of the day.
Thank you very much.